Good morning, students. So today we will be discussing startup finance and value at risk. So let's start with the startup finance. So students, for startup finance, first of all, we need to understand that what is exactly called as a startup. Then only we can study that what are the different type of financing techniques for that startup. So if we see a startup is actually defined as there are some conditions which has to be fulfilled first, then only any entity can be regarded as a can be called as a startup. What are those conditions? Now the first condition is that the startup would be there for the initial 10 years. Let's say today the company is getting incorporated, or there is a LLP getting incorporated. So from today till 10 years from now will be the time period under which it will be regarded as a startup. So up to 10 years, from the date of incorporation. This is the first and foremost condition. For example, if a company is there which is 15 years old, that will not be considered as a startup because already that company has spent a reasonable amount of time in that particular industry. Similarly, if it is for 11 years also, it will not be regarded as a startup. So startup is something which is up to 10 years from the date of incorporation. During that time period, that company or entity, whatever it is, will be regarded as a startup. Now, what is the legal form of this startup? Not all the type of companies comes under startup. Now, if you imagine there is a public limited company which has already raised an IPO, which is listed after doing the book building process, IPO, then its shares got listed. So do you really think that, and it is still in the first 10 years of its operation, it's still here in the first 10 years of its incorporation, then do you still feel that is it a startup? No, right? Because it is already a big company incorporated as a public company which has raised a lot of funds from the public at large. That means it is not a startup. Correct. For startup to initiate, it should be starting from a smaller scale with a smaller capital, smaller turnover. So hence we say that the legal form can take place for a startup company to be, let's say if it is a private limited company, if it is a private limited company, then only it will be regarded as a startup. Or if it is a registered partnership firm, there is a partnership firm, let's say there are 2 3 co-founders, they have gone into a partnership firm and they get it registered. That is also okay because generally partnership firms don't operate on a very high level, and similarly private limited companies as well. And the third form is actually a partnership only but a limited liability partnership, LLP. This also needs to be incorporated and registered before it can come into existence. So these are the 3 valid legal forms of a startup that is given. Okay. So first of all, the startup should be in the first 10 years of incorporation. The company or the entity should be in first 10 years of incorporation. The legal form of the entity should be either it should be a private limited company or it should be a registered partnership, or lastly it should be a LLP, which is again registered only. Correct. Now what is the third condition? Now the third condition is, let's say the business, for example, satisfies A and B both the conditions. For example, any startup satisfies A and B both the conditions. Now, and they are, let's say, a private limited company, they are into the first 10 years of their incorporation. But what they do is their business model is such that they have far exceeded their turnover. Okay. I mean, they are a 1,000 crore rupees turnover company. That means, do you really think, say, if they're making 1,000 rupees, 1,000 crore turnover, so are they still operating on a smaller scale, or are they still operating as a startup? No. Now the proper growth has come. They are able to make a lot of money. Their turnover is good. Their P&L would be healthy. So hence the third condition restricts the turnover up to 100 crores. Turnover should not exceed rupees 100 crore in any financial year. If this is exceeded, then you are coming out as startup. Then you are an established company. You are not a startup. Correct? So if it is up to 100 crore in any financial year, then only you will be treated as a startup. Now, combining all these three conditions, up to 10 years from date of incorporation. Second is their legal form can be anything. Only these three things that are listed, and their turnover should be up to 100 crores. It should not be more than 100 crores. These all three conditions says that it's already a basically the smaller size company. Correct? Now the fourth part is, now what if you talk about a group, let's say a very big group, for example a business group, correct, for example Reliance for that matter. Now if they have started a new business, correct, so what they can do is they can easily do a demerger, create a new company in, let's say, private limited company form. It is first 10 years of their incorporation, and since it is a new business, the turnover they likely estimate is about, let's say, 100 crore, up to 100 crore. So what will happen essentially is that in that case also, there is an established group which has done a demerger or done a hive off, and they have basically created a new company, which will again mislead the rules. Why? Because ideally this is not a new venture that is coming out, right? It is only because of a reconstruction of a business which is already there. So even in that case also, it will not be regarded as a startup. For startup to be there, it should not be because of any, the resultant entity of startup should not be because of reconstruction of a business already in existence. Okay. Now, so basically it should not be because of any reconstruction in the existing business. If that is the case, then everyone, what they will do is they will start forming multiple companies of the existing business. Correct? Even large business houses, they will also start forming smaller companies, because if you are registered as a startup, if you qualify for startup, there are a lot of incentives that the government gives. Correct? In terms of financing, in terms of taxation benefits, in terms of a lot of things. So in that case, all the business houses will do this. But to avoid this kind of a thing, it is clearly mentioned that it should not be because of any reconstruction of a business already in existence. There should be something new that should come out from the entire proposition, from the entire venture of this. And the last part. Now, the last and foremost, the last part is very logical. So what does it say? Now, for example, I start a limited liability partnership, for example. Okay, and I have started just now, so I am satisfying condition A, B, and my turnover is also, let's say, 50 crore. Correct? Not 100 crore, it is 50 crore only as of now in the first year. And it is not because of a reconstruction. I have started a new business of my own, which don't have any links to any other business that already have an existence. But through that business, I'm just doing a normal trading. Okay, I'm just purchasing the food grains and I'm selling it. That's all. Correct. And that I'm doing under the limited liability partnership. So do you all of you feel that whether business that I have just now started should be a startup? In layman terms, yes, it is a startup, but what value added things it is doing to the either the business I am doing, or to the market I am serving, or to the consumers I am giving it, or from the suppliers I am taking it, or is there any new technology that I'm using it? So hence, to go for the proper value addition, by value addition I mean proper improvement in the way the business is done, that is the last condition. Because the conventional methods, the old methods, which let's say I'm just taking order on phone and I'm passing on the order to my suppliers on phone, simple, that is not a startup. That can satisfy A, B, C, D, but that will not satisfy condition number E. So condition number E says that there has to be an innovation, there has to be a development of new product, or there has to be a development of any new process or service, and that all should be driven by a technology or some kind of an intellectual property. So they are saying that your focus should be that you should do a proper research and development R&D, and hence you should innovate, or you should be able to develop a new product which is not in existence. So innovation means existing product with some new features, right? But with some new things, and any process or service which is, and all these things should be because of the technology, correct? Because of some technology which is not already there, or intellectual property which has been designed specifically for the business. Innovation, development of new product, or it is, let's say, process or services which should be driven by technology. We should use technology, we should use technology for carrying out each and every step of the business, correct? Or some kind of an intellectual property. Doing the things in the old manner will not help. That will not be regarded as a startup. Doing the things in an innovative way, in a new way, which are not established, using technology intensive techniques, or developing some kind of an intellectual property, okay, that will really help, and that those entities or those particular companies would be regarded as the startup entities. I hope the definition is clear. Once these A, B, C, D, and E conditions are satisfied, then only we say that these are the startup companies. And once it is qualifying as a startup company, then it can easily avail the government services. Okay, and this definition is actually given by the Government of India through a notification. Okay, so hence these are basically the 5 different types of conditions that are there. So basically, entity, in the last point, it says that entity should work towards the innovation, development, or improvement of the products or processes, correct? And it should have a higher potential of employment generation or wealth generation. It should lead to the newer improvements in the existing business or in the existing product where it is set it out. Okay, so this is done. Now, coming to the main part. So till now we have studied that what are the different conditions using which we can say that a particular entity is a startup or not. If it is a startup, then it is okay for that company to avail the government schemes. By government schemes, they have a lot of incentivization schemes, taxation schemes, all those things. Now, coming to the financing part. Now, students, if you see, all these are basically smaller companies, correct? They don't have very big capital. They don't have really very big sources of funds. So But they, on the other hand, to do this technology intensive tasks or to develop a intellectual property, they need a lot of investment. Correct? They would need a lot of investment. Why? Because without those investments, they will not be able to carry out their R&D thing. Okay. So hence, they need a lot of money. And hence, there is a need for us to understand that what are the modes of finance available for a startup. What can be different types of modes that are available for a startup? Sairam is asking, its company should satisfy all conditions. Yes, Sairam, the company should satisfy all these conditions, okay, to make sure that this company can be called as a startup. Don't use the word company, because we have company, we have partnership firms, and we have LLPs as well. So hence, better to use, let's say, startup only. So the startup will be in such legal form with all the 5 conditions fulfilled, then only it will be said as a startup. Okay. Now, because there are varied opinions. Let's say somebody might say that why 10 years, only 5 years, why 100 crore, it should be in the Indian context, it should be 500 crores, correct? But government have come up with these numbers to avoid any type of a confusion, so that there is no confusion at all in the overall numbers. Okay, and there is a consistency across the way every business is analyzed as a startup. Now, the first term that we use is called as bootstrapping. Now, students, please understand what does this term is called. There is double P in this. Now, bootstrapping means that broadly we can say there are 2 things in this. Okay, one is personal finance, and second one is through the operating cycle of business. For example, vendors / debtors. Okay, so basically, when we call that we are doing a bootstrapping for a startup, in these 2 conditions, one is that if someone helps with the personal finance, if let's say the founder of the startup itself brings some personal finance, his or her personal savings into the business, that is called as bootstrapping. Correct? Similarly, if we go and discuss with our debtors or with our vendors, for example, there is a new startup, it will go and discuss with their suppliers that can you give me this much amount of goods in a credit form for a 90 days credit, 60 days credit. I will pay you once I am able to realize the money. That is called as operating cycle of business, and that is this form of a finance is called as a bootstrapping. Correct? Now, we will, so these are the 2 broad categories. One is personal finance and second one is the operating cycle of the business. Now we will see the specific ones. So the first type of finance in bootstrapping is trade credit. Now students, imagine that there is a newly formed startup. Okay, this is a newly formed startup, and in the startup they have devised one product which is not actually existing. That's a new product, and for completing that new product, okay, there is a vendor that they have. This is a startup, this is a vendor. They need some raw materials from this particular vendor to complete that product, okay, that they have already analyzed, and this is the vendor who is available, who is supplying those raw materials currently in the market. Now, what does trade credit means is, so trade credit is simply this vendor says that I always operate on advance basis. You give me money first and then I will give you the goods. But since these guys are startups, I mean, these people are working in the startup, so they will approach the vendor and say that, okay, We have just now started. This is our first purchase order that we are giving to you. And we are actually short of funds because we have just now started on a very smaller scale. And we need a lot of investment to be done. So hence our cash flow position is not that great. We request you to please give us, let's say, 60 days of credit or 90 days of credit. So what they will do is within, let's say, next 20 days, they will finish the product. Then they will sell it around, let's say, 20 to 30 days, correct? And then they will realize the realization they will pay to the vendor. That is called as trade credit. So trade credit is basically asking the vendor to give some sort of a credit days, correct? So basically it is asking for credit from vendors. Okay, simply based on the relationship we have to develop, or it may be because of the actual situation that is there. So that is the first part, the trade credit. Second part is factoring. I think factoring also all of you would be knowing because this is a very common term. So what happens in factoring is, now again there is a startup S. Now this has to do with a debtor. So as I said now, that bootstrapping is actually arranging for the finance through the operating cycle itself. Operating cycle means the working capital cycle of the business through vendors and debtors. So through vendors, we have done trade credit. Now comes debtors. So what will happen for factoring is, now let's say the startup has sold the goods to a debtor called D. Okay, and similarly, the startup has also asked for credit from its own vendor. The debtor is also asking for credit from the startup. Let's say it is asking for 30 days of credit. So he says that after 30 days, I will pay you the amount of whatever the goods that you will give me today. Startup says that, okay, because this is my first order, I have to grab it anyhow. So I am okay to give you a credit. But now what will happen? Startup will need the funds immediately because it cannot block the working capital for 30 days. So startup will approach to a third party, let's say a bank or any financial institution which is engaged in the factoring. So what this factoring means is, in factoring, they will take this amount. Let's say the amount receivable is 1 lakh rupees, correct? Rupees 1 lakh. So what they will do is, in case of factoring, they will give the amount to S today, whatever is the receivable amount, and then they will recover after 30 days from D. Simple. So they will pay today and they will recover from D after 30 days. Now, in this, they will not pay entire 1 lakh. They will pay, let's say, 98,000 because 2,000 they will put for their own commission. So that 2,000 rupees loss, or let's say interest cost, or let's say factoring cost, is borne by S. That is one. Second is, there are also these kind of products available in the market where the factoring will pay 1 lakh here, but the debtor here will pay 1 lakh 2,000 to the factoring agency after 1 year, after 30 days. Okay, so it can happen depending on the mutual understanding or the mutual consent between all of these three parties. So this is called as factoring, correct? And this, I think all of you must be knowing that this is on a recourse basis and a non-recourse basis. Recourse basis means that if debtor is not able to pay to the bank, then bank has the right to recover it from the startup again. And non-recourse basis means there is no, basically in case of a default from the debtors, bank cannot go and ask the money from the startup. So there is no recourse basically. Correct. Recourse means that there is a recourse available for the bank to go and claim it. Correct. So this is factoring. Then the next part is leasing. Now, students, what happens is generally startups are those which don't have a good capital base initially. They don't have a very high scale of business. So they even cannot invest in a lot of assets as well. Now, for example, they need fixtures and furnitures. They need property, plant and equipment. They need computers to run the technology. Correct. All these three things they need. For example, any startup. Now, what will happen is, since they don't have enough money to purchase and do a capex here, correct? For doing the capex, they need to have that hard cash with them, which they don't have. So what will happen? What will happen? Instead of going and purchasing it, they can find some companies who are currently giving them on lease, and they can take it on lease. For example, instead of purchasing anything at 1 lakh rupees, okay, they can actually get it on a lease at 1,000 rupees. Okay, students. So if they are getting it at 1,000 rupees, that means they are avoiding the cash outflow at 1 lakh rupees, which is the current capex. And hence they don't need anything on 1 lakh. They will just do the 1,000 rupees per month payment for taking these on leases. So this is also a good way to finance your requirements on the fixed assets. Correct. So a lot of startups will go for a leasing option rather than purchasing it. So these are the three things. So bootstrapping means that, so basically we are trying to scratch it out, whatever is available in the operating cycle or within the personal financing of the startup. So operating cycle means this vendors, debtors, and even on the leasing side. Okay, whatever is possible, they will just take that amount. They will take that thing and they will move it forward. Okay. Yeah. Now coming to the second part, after bootstrapping, there is a second mode of finance that is called as angel investors. Now, who are these angel investors? As the name suggests, angel means someone who rescues, correct? So let's say there is a startup. So this startup is in actual need of money, correct? Because it has to invest again in the technology, in the initial building blocks of the business, a lot of things. So what will happen is this startup will have some kind of a contact, correct? So let's say this have contacts with the relatives or with some high net worth individuals as well who are HNIs, correct? So what will happen is those people, or let's say those relatives which have a lot of savings of their own, and they're willing to give money for the startup to start their activities for the initial starting phase, those people are called as angel investors. So basically these are the people from known contacts. These are people from the known contacts for the startup entity, and they give their own money to the startup and they give their own savings to the startup, but they give for the initial requirement, for the very initial requirement, they will give this to them and tell them that, okay, you start the business, we will see on returns later on. If there is a return, you give us the return. If there is no return, then we are okay, because these are known contacts, correct? So there is no clear cut expectation from their side on returns. They will not expect you, because the idea, the purpose from their end is to help you to start the business, not for them to earn the returns. That's why they are called as angel, because angel, they are rescuing, correct, without any further expectation, correct? Yeah. Now the next part is the venture capital fund. This is the main part. I will use the next page actually, because this will take up the entire this thing. So students, now please understand this very carefully, as this is something new, because you might already be having you might be already knowing on, let's say, bootstrapping, which is the operating cycle, and even on the angel investors, but this is a somewhat technical thing, so I want all of you to please pay attention now. So what is a venture capital? Now venture capital is again a commercialized form of giving a loan to a startup, or let's say giving a funding to a startup. We cannot call it as a loan, as a funding. Okay, now it is one form of private equity, one form of private equity. So don't get confused. What is private equity? See, there are two things, right? One is the public equity and one is the private equity. In public equity, there is a IPO, there is a prospectus that is filed, then public at large invests, correct, through a book building process. Then after book building happens, the shares are issued and listing happens. This is called as public equity process. Simple, correct. But in case of a private equity, the public at large is not involved. Only a few group of people are involved, or it can be a one person also. Private equity means only one person with the sole objective that today what is the investment that they are doing and tomorrow what they expect out of the company as a return, correct. So there is no public at large, but there are only, it is a closely held group of people or even a single individual also. That is called as private equity. Once they give the equity, once they invest, that is called as private equity. So in a layman term, again I'm saying, so this is the difference between public and private equity. Now we are saying that venture capital is one form of a private equity. So what will happen? Now imagine some of the group of people who have, or let's say some of the group of the institutions who are having a surplus cash to invest. Okay, if they have a surplus cash to invest, for example, pension funds. If there are pension funds, they will collect the pension contributions from the employers and the employees. They will be having a lot of cash to invest somewhere. They're having a surplus cash. B, if you talk about banks / financial institutions, C, high net worth individuals. High net worth individuals, HNIs. Or there can be other corporations also, correct. So anyone which is having a good amount of cash to invest, they will come all together and they all will create a pool of money through whatever form they want to put, correct. So let's say this pool of money is created by the contributions from all of them. And so basically these are funds, these are amounts that are there, correct. And this pool of money will invest in startups. Equity in startups invested through this pool of money. So through this pool of money, the investment will happen in the startups. Now, before doing the investment, deal finalization, a lot of things will go. They will analyze the startup. They will see that what is the future possibility that startup will make up money, or how good they are able to give back the money, correct. So all those things will be analyzed, which we will discuss further. But for this particular type of a model, a lot of these institutions will come together, pool their money, and then they will invest as the equity in the startups. Now, with what objective? What is the objective? See, students, we have studied that the objective of angel investors is not to mint the money. They just want the startup to initially start. That's all. That is where angel investors are giving the money. Although they might expect that once the business flourishes, they will get their money back along with the handsome return. But the purpose or the objective of angel investors is totally different from the venture capitalists. So venture capitalists are those people who are part of this venture capital. Okay, let me explain what is their objective. Yeah, sorry. So they have three life cycles. One is, first of all, buy. So in case of buying, that means in case of investing in a equity of the startup, or let's say giving equity to the startup, they will identify the deal. Then they will evaluate the deal. Identify deal. Deal means that which startup to invest. So startups will go generally and pitch it in terms of the presentation. Correct, that this is their idea, this is the new thing that they are going to do, this much is the market capitalization, this is how they are going to do the commercialization and realize some amount, or this is the problem statement that they are going to solve. So they will identify the deal, the right kind of a startup company to invest, then they will evaluate the deal, and then they will execute the deal. Correct, these three steps are involved in buying process. Okay, so evaluation means they will see that whether it is really worth to invest in that business, whether it is going to give some good returns in future, or what is the possibility that the company will do good in the coming future. What is the prospect around the business model that these guys are suggesting, or the product which it is solving. Okay, and execute the deal means finally the giving the money and giving the funding. So this is first. Second is grow. Now, the second objective of these venture capitalists is that they want the business to grow. They want the startup to grow. Now, this thing, they will also contribute through their expertise. They will come to the board of directors of the startup company. They will, so their job does not end by just giving the money and letting them do what they want to do. It also means that they will be part of the regular decision making process. They will influence a lot of decisions within the board of directors by sitting as one of the key positions within the board of directors, because they have invested in the equity of that startup. So they will come from an expertise background. So they will be the people who are already having experience in these kind of businesses or in these kind of things. So in growing, so take decision making, or simply I'm putting decision making, and this will essentially mean for them that making deals successful. Actually, they would want the deal to be successful. And how they can do it? By ensuring that they are increasing the current value addition. So they are keep on adding the new things. But I mean the new improvements so that the value addition happens. So this is the grow, buy, grow, and the third part is exit, which is sell. So they are not doing all these things for a charity, right? They are not going to do the buying and growing of the startup for a charity. They will have to eventually realize the gains that they are able to make out of the entire deal. That will happen at the right point of time when they are going to sell off their proportion of share in the startup, which is called as harvesting. Correct, harvesting the profits. Simple. So they will sell off their proportion, or let's say the percentage of proportion, to some other company, and they will realize the amount. Okay, so basically, let's say they buy today, they will take 5 to 10 years to grow, and after, let's say, 5 to 10 years, whenever they want to exit as per the plan, then they will exit. So this is after 5 to 10 years, they will exit and they will realize the gains to them. Now, if we see, students, the life cycle of a VC fund, venture capital fund, what are those? So the first and the foremost process is the fundraising. Venture capitalists are also raising the funds, correct? Because they have to create the pool of money first. For doing that, they will contact all these institutions, correct? So the first and the foremost step is fundraising. Second is investment phase, in which they will analyze, evaluate, and execute the deal, which is the buy process. Correct. They will do the investment. Third is holding period. Now they will hold their investments, assuming that for 5 to 10 years, they will reap some valuation improvements, some kind of a growth over the existing amounts. And the last part is exiting investment. Okay, students. So while they will exit, they will realize their own gains. And what they look for, VC is looking for one, high growth technologies. See, now there are some technologies which are actually very good, which are very innovative, but they don't have any potential for growth. Correct, because those solutions that technology offers is generally not required as a utility. Correct. So VC will always look for that which kind of a technology is a high growth technology. Second, media. So there is a proper brand building that is happening. So there is a proper information that is going through the proper channels of media. And the last is, it is a consumer driven company. Consumer driven means that always the solutions that the company creates or the startup creates should be coming up, taking into the mind that what a consumer needs. Correct? What are the needs of that consumer and how it is operating. So in response to those questions, to these consumer driven, so basically let's say consumer have a problem statement. Now startup technology is trying to give a solution for that problem statement. So if that is the case, that VC will be very happy to invest in that kind of a company where all the solutions are consumer driven. Correct. So consumer is their core heart of the technology solutions. Now let me take the venture capital again, in detail. Yeah. Okay, now let us introduce some of the technical terms and try to understand what does this mean. So students, let's start. There is a, let's say, private equity group. Private equity firm. Now students, what are these private equity firms? Private equity firms means those firms, let's say some kind of a smallly held partnership firms, which are again in which a lot of high net worth individuals are partners, or a lot of entrepreneurs are partners who have the objective of looking or investing as private equity. Correct, not as public equity but as private equity. They want to invest in a privately held company, not in a public limited company. Okay, so they come with that objective. So there is a private equity firm who have these objectives. Okay, now what they do is they want to start a venture capital. As I told you, venture capital is also one form of the private equity. It is stemming from private equity. Correct. So what they will do is they will look for these pension funds, banks, financial institutions, other HNIs, or any corporations. Correct. So these all people are called as limited partners. Limited partners. These are called as LPs, limited partners. Because why limited partners? Because their liability is limited to the extent of the contribution that they have done. Very similar to the equity shareholders. Correct. The equity shareholders in a company, in a limited company, have the liability limited to the extent of amount that they have paid. Correct. So basically, if the company goes on default, they are not liable to pay anything over and above the value that they have already contributed. Only to the extent of value that they have contributed is what they are going to be liable for. Correct. That is what is the limited liability is, and hence these are called as limited partners. They will actually create this pool of funds. Correct. This is called as a SPV, special purpose vehicle. Special purpose vehicle, which is actually formed in the form of a trust or in a form of a limited liability partnership, which is entrusted with the funds that are contributed by the limited partners. And this private equity firm will appoint some of their general partners. These are called as general partners. These are again some individuals who are entrusted with the task of collecting this money and taking decision on the investments for this money. And these general partners holds fiduciary relationship with limited partners. So basically, they are having fiduciary relationship with the limited partners. What is a fiduciary relationship? So fiduciary relationship means that they are going to handle their investments. Okay. So they are responsible for the security of their investment, for ensuring that the investment is not going down. They will have to carefully analyze, assess all the things in the overall scheme of this arrangement. So these people are called as general partners. These general partners will be appointed from the private equity firm to manage this SPV. And they will also bring, let's say, some kind of a contribution. So for example, SPV is total 100 is having the funds of 100%. Out of that, let's say 2% will be contributed by general partners and 98% will be contributed by the limited partners. Why they're contributing 2%? Because that will bring a sense of ownership to them. Correct. That will bring a sense of ownership to them, that their money is also invested. Hence, they cannot be careless in investing that money. Correct. So till now we have studied that there is a private equity firm which have these general partners. So they will appoint general partners who are again some kind of individuals who have very good kind of expertise, knowledge, who are into this business. They know that which kind of company will work, which kind of company will not work, and they will bring some 2% sort of a investment also in the trust or LLP, which is the SPV, which is incorporated. Balance 98% will come from the limited partners, which are these contributors, and hence they will create this entire pool of funds. Now, there is another person called manager or advisor to the fund. Okay. Now, these general partners are already very busy, right? I mean, they will source the funds, they will create the SPV, they will do the other things, they will do the deal analysis and all. So hence they appoint a manager or advisor to the SPV. Now the role of this manager or advisor is to bring the deals and also help them to evaluate the deals. So these are basically technical experts. These managers or advisors are technical experts. And these general partners are basically more from the entrepreneurship background, right? These would be technical experts because of the experience that they have, but the person who is having the technical expertise is this manager / advisor. So it will, let's say, bring some 10 deals on the table with the general partners, and they will analyze out of those 10 deals. They will finalize, let's say, 3 deals, and they will invest on those 3 deals. Investment 1, 2, and 3. Simple. They have finalized the 3 deals. In all these 3 deals, they will invest, and then they will buy, grow, and sell. So this is the life cycle that we have already seen. This will be completed in, let's say, 5 to 10 years, and they will realize the whatever amount they will get, and using that, the returns will backflow to this LPs as well as to GPs, and hence to the private equity firm. Okay, students, I hope this is clear to all of you. This is actually the proper technical term called as venture capital. Now, this entire model is giving funding requirement to the startups. Now, students, if you see, if all of them, now what are the different types of entities involved in this? First of all, there is a private equity firm who is responsible for appointing the general partners. Second is the general partners themselves. Third are these limited partners who are contributing the amount. Fourth entity is this SPV. Fifth entity is this, not entity, but the party to this is manager or slash advisor. Then sixth are all these startups put together. Correct. So you see how many parties are involved in this. Correct. In the entire model to operate. If all these parties, all the above parties in India, this is called as domestic structure. I am coming to the different types of structure. So if all these parties are in India, it is called as a domestic structure. But there is a second type of structure called offshore structure. Now, in case of a offshore structure, the investments, the ultimate investments, which is investments, that is, I'm talking about startup here, correct, is in India. So the investment will happen in India. The ultimate, which is the sixth point I'm saying, the sixth parties are in India. The investment will happen in India. The SPV, which is this trust or LLP, is incorporated outside India. Okay, students. So that is why it is called as offshore, because this SPV is created outside India. This is not in India. This is created outside India, but it will invest within the startups in India. And since it is investing for the startups that are in India, the advisor slash manager is also in India only, who manages and gives due diligence on the project slash deal. Okay, students. So this person who is in India will be managing and will be doing the due diligence, will be doing all the analysis sitting in India only, because ultimately the investment is happening in India. This is called as offshore structure. There is a, so we have studied one domestic structure, and in this is the offshore structure part A. There is another type of offshore structure, which is part B, which is called as unified structure. Now, what will happen in case of a unified structure? So in case of a unified structure, this SPV is still outside India. Okay. But this SPV will not directly invest into our companies, into the India's startups. It will again form a trust in India. So already SPV is a trust itself, but again it will form a new trust in India, and this will be in India. And in this trust, local Indian investors can also invest. Can also invest. Correct. So first, the investment will come from outside through SPV in a trust formed in India, and the local investor, the local Indian investor can also invest. Finally, this entire money will be invested in India. Invested in startups in India. Simple. This is called as unified structure. You're getting my point. So we have covered venture capital model and the venture capital parties that are involved, as well as the structure. There are, as we discussed, one for domestic and two for offshore. One is the offshore itself and second one is the unified structure. So these are the only technical things in this topic. Rest all, I think, is very easy to understand. But still, let me also finish the next part in the startup finance. Okay. Now this is done. Now coming to some, so these are the three modes of financing. One is bootstrapping, second one is the angel investors, and third one is what? The venture capitalists or the venture capital fund, which is the VC fund, one type of the private equity funds. Correct. So now you can go through the life cycle, the different stages, the different, the entire process, and you can relate to what I have discussed in this session. Correct. Now, coming to some of the innovative ways. Now, if the question comes asking for what are the innovative ways to finance a startup. The earlier one we studied, that was the mode of finance for the startup. This is the innovative ways to finance a startup. Correct. Now, first of all, the most innovative or the most popular way is personal financing. Simple. Invest personal savings. Whatever the personal savings are for that particular founder, he or she will invest it into the startup directly. That is called as personal financing. Second, personal credit line. So this personal credit line means that they have a credit card with them. Correct, because that is their own personal credit card, which they will use for the purpose of business. That is called as personal credit line. Then family and friends. The money can be seeded from family and friends. They can invest into the business. That is again a way to finance the startup. Then peer-to-peer lending. Peer-to-peer lending means that, let's say there are 4 different startups. Whenever in need, some of them will give funding to the other. That is called as peer-to-peer lending. Peer-to-peer means at same level. Okay, then crowdfunding. Crowdfunding means that, student, now there are some platforms. Okay, this would be a new term. So there is a platform. By platform, I mean there is a website. Okay, you simply understand that there is a website which we call as platform. On that website, or let's say on that portal, lot of individual lot of individuals will contribute smaller amounts. Let's say even 100 rupees for that matter. Correct. And that's how the pool again will be created here. And on the portal itself, they will give details on the different startups that are available. Details on different startups. Let's say startup A, B, C, D, E. These all startups will be listed on this platform. And the individuals will go and check that what is that startup doing, what is the profile of that startup, and then they can invest these smaller amounts as well in the startup. This is called as crowdfunding, because the crowd is huge and the amount contributed is less. That is why this is called as a crowdfunding. Okay, students. So this is also actually a startup only. The crowdfunding itself is a startup. A lot of websites, a lot of portals that are running as a crowdfunding platforms are the startup itself. Then the next part is micro loans. Micro loans means the loans for the smaller businesses that are given to the individuals at even a lower rate of interest that can be given. Then the next part is vendor financing. So what happens, students, in vendor financing is that, so basically the the vendor itself will give us the money so that the startup can purchase the goods from vendor itself. So it is again kind of a credit from the vendor, correct? So this is credit from vendor. The next part is purchase order financing. So let's say we have issued a purchase order, but for executing that purchase order we need money, correct? So purchase order financing is means that equivalent to that purchase order. So the purchase order financing companies will advance whatever is the requirement on that purchase order, and hence the PO will be executed. Later on, the amount can be paid to the PO financing company. Then the last part is already factoring that we have already studied. Factoring accounts receivable. Simple. So basically, PO financing is after, let's say we give a PO, against that PO, we also give an advance to carry out the execution of that particular PO. Okay, students. So mostly, students, that's all from the startup finance from my side. Rest all you can please go through, and you can ask if you have any query, because rest all is just a simple thing. Okay, let me discuss certain other aspects as well. The last aspect is the pitch presentation. So basically, for raising these funds, they will have to prepare a pitch. Pitch means a PPT, which will have a lot of detailing. Let's say what is the problem statement that they're targeting, what is the profile of the particular startup, what are they into, what is their team buildup of, correct? And then what is the solution that they're giving, who will be doing the marketing, sales, what are the projections that they're having, what is the likely income statement that they have, what is the future projected balance sheet and P&L that they're having, what is the future projected cash flow statement, and what is the exact business model, and what is the competition that they're having, correct? And hence they need what amount of financing requirements. So all these things will be done within this startup. So students, if you see the major things to understand here, and see, since this being a very theoretical topic, there is a need to understand and there is a need to go through all the things in detail, correct? So I request that the exact wordings, please go through from the study material itself in detail. The technical part of understanding is what we have already covered. So what we have covered is what is a startup, first of all. That is very important, because there are some 5 conditions that needs to be fulfilled before a company or before an entity can be called as a startup. Second thing, that will help in the overall consistent approach for the government also to incentivize, correct? Third thing, we have studied what are the different modes of financing. One is bootstrapping, one is the angel investor, and the last part is the venture capital. Venture capital is a technical part where we have to see that what are the different processes and how the model works, correct? And what are the 3 different structures of a venture capital, one in domestic and 2 in offshores. Then we have studied some of the innovative ways of financing, and then lastly the pitch presentation. Okay, students, now let us go to the second part, which is value at risk. Now all the students, please pay attention. This is a kind of a technical topic. Yeah. So I am going to write a statement. We will take inferences from that statement one by one, and then we will try to understand what is a value at risk. Correct. So students, if you see the general understanding or the general, I mean, what we perceive while we read something called as value at risk. Value at risk means simply that what is the amount of loss that I am going to incur. Simple. Correct. Value at risk means that if I have 100 rupees with me and I invest in some kind of a portfolio, so how much I can expect that 100 rupees will go down. For example, there is a 10 rupees loss that I can incur. That will be given by the value at risk. So what is the maximum amount of loss that can happen to me over a period of time? That will be given by the value at risk. So I'm just giving the proper technical statement and then we will understand it further. So value at risk measures the maximum potential loss it measures the maximum potential loss in the value of a portfolio over a given period of time for a certain confidence level. I will make you understand the meaning of each and every term in this value at risk, and then we will cover 4 questions also to make our understanding better. Yes, Shivam. So we are saying that value at risk. First of all, you imagine that value at risk is some kind of a model. Okay. Now, if you remember in derivatives, we have studied Black-Scholes model. Correct. Black-Scholes model will give you an output. What kind of output? It will give you the value. It will give you the price of an option. Correct. What is the premium of an option? That will be given by the Black-Scholes model. And it will take some inputs, some set of inputs. It will apply that formula. And then finally, it will give us that what is the premium value. Similarly, value at risk is also a model. Okay, is also a model, is a framework which will give us what? Which will give us that what is the maximum potential loss? What is the maximum potential loss? Okay, so this is the output. Value at risk. So I'm talking about this is a model. This is a, let's say, mathematical model which will give you a output of maximum potential loss. This is the output. Correct, students? So it will give you the output or as what is going to be the maximum potential loss and what all inputs it will ask you. It will ask you that, okay, this is the maximum potential loss I'm going to have. So the input that it is going to ask you. Just a second. Yeah. And what are the inputs that it is going to ask you? One is that what is the level of confidence? This is A. I will explain these things. Number B is the standard deviation of returns of portfolio. value of the portfolio time horizon / time period, whatever it is. Now, what types of input it will take? It will take what is the level of confidence, what is the standard deviation of returns, what is the value of that portfolio, and what is the time period. All these 4 or 5 things it will take into the mathematical model, and then it will throw a maximum potential loss as output. Now, let me again, okay, as of now, I have not even explained what are these terms, but again, I'm just taking an example, and then we will again come back to this definition. Okay. Now, students, level of confidence is, let's say, 95%. For example, now what does this mean? If we say that level of confidence is 95%, that means that ultimately whatever we are doing, that has a 95% chance, that has a 95% probability. Confidence means that we are confident that 95%, and how much we are confident is 95%, which is called as the level of confidence. So for example, if I have to calculate a probability that I will reach from, let's say, we can say from Delhi to Mumbai, for example, probability to reach Mumbai from Delhi within 2 hours is actually 95%, for example. So this will mean that level of confidence is 95%, correct? So that means we are confident to the extent of 95% that in 2 hours we will reach from Delhi to Mumbai. That is called as level of confidence, correct? So level of confidence means that probability percentage of that thing to happen, of that particular thing to happen, correct? I hope I'm clear. So level of confidence means 95%. I am confident that I will reach to Mumbai from Delhi in 2 hours. Correct. That is called as level of confidence. Level of significance is actually 5%, which is 100 minus level of confidence. Correct. So basically, what does this level of significance means? Probability to reach Mumbai from Delhi beyond 2 hours is 5%. Can I say that if I say that there is a 95% chance that I will reach within 2 hours? So can I say that there is a 5% chance that I will reach after 2 hours? That means beyond 2 hours. Both the statements are same only, right? But it's just a different way of it's just a different way of presentation. I am saying that within, I have a confidence of 95% that I will reach from Delhi to Mumbai within 2 hours. Can I say that I have a 5% chance that I will reach from Delhi to Mumbai in more than 2 hours? You're getting my point? So this is what is called as the level of significance. Level of significance is the exact opposite of the level of confidence. Correct? Now let me take another example. Let me relate now to the topic that we are studying. I hope the confidence level and significance level is understood to all of you. Students, again, I'm asking, please ask any questions if you have on this, okay? Confidence level is, let's say, 95%. Significance level is, let's say, 5%, which is nothing but 100% minus confidence level. Correct? We can calculate this. Time period. We are talking about 1 day actually in this case. Okay. We are talking about only 1 day. We have a portfolio value of around, let's say, 20 lakhs. Rupees 20 lakhs. This is the portfolio value that we have. Okay. Now, SD is also given to us, but I'm not putting that value because that value as of now we will not use in our understanding, because I'm just wanting to create the understanding here. Correct. Now, if we arrive at using VAR, if we arrive, let's say 20,000 is the maximum loss that is coming. Correct. This is coming as an output. We put all these things into this model, and we arrive at the maximum potential loss of rupees 20,000. So what does this first of all means? This means that within 1 day, there are 95% chances that the maximum loss will be 20,000. Very easy, very simple. Within 1 day, the maximum loss is 20,000. That can happen. Correct. The maximum loss is 20,000. The probability of this, is 95%. We are only 95% sure that the maximum loss will be 20,000 in a single day on this kind of a portfolio where you are having an initial investment of 20 lakhs. Okay. So we are saying that the maximum loss is 20,000. So it can be anything, let's say 18,000, 19,000, 19,500, or even 20,000. It can be maximum up to 20,000, and the percentage chance or the percentage surety for that is 95%. Now, students, just see how I am turning the statement here. This is the first part of the statement. The second part, I can also say that within 1 day, the minimum loss is rupees 20,000. The probability of this is 5%. This is considering the level of significance in mind. This is considering the level of confidence in mind. The first part is considering the level of confidence. The second part is considering the level of significance. So if we say that there is a level of significance which says that there is a 5% chance that your loss will be higher than 20,000. Simple. That means the minimum loss is 20,000. There is a 5% chance for that. So in 5% cases, your loss will be more than 20,000. And in 95% of the cases, your loss will be maximum 20,000 in a particular day. This is called as value at risk. To analyze this statement, to arrive at this 20,000 rupees, is this entire model is called as value at risk. So can you say that how much is the value at risk? the value at risk is 20,000 at a level of confidence at 95%. So this is always expressed at a certain level of confidence. Now, it can be, let's say, 98% and 2% also. It can be 99% and 1% also. It can be 90% and 10% also. It can be anything. If you change this, the loss will also change, correct? At 95%, it's 20,000. Let's say at 98%, it will be higher or lesser. Whatever it is, we will see how to calculate that. Correct. But what I'm trying to say is that at a certain level of confidence, what is the maximum loss that can happen to a portfolio value over a period of time? The period of time we have taken here as 1 day. It can be 10 days also. It can be 30 days as well. It can be 1 day as well. Sorry. Okay, students, I hope the value at risk concept is clear per se. Now let me go to the second part. Students, we always say that the returns from security are normally distributed. For example, if we put the returns in this chart, we will get a bell curve shape like this. This is a normal distribution table. Please refer my discussion while we were studying the Black-Scholes model in our derivatives, where I explained what is a normal distribution table. We studied that there is a Z score that needs to be calculated. We need to calculate Z score, right? What is that Z score? Z is equal to X minus mean divided by standard deviation. We said that normal distribution, this is an area under curve. Area under curve represents the probability, right? I'm just taking it a bit faster because we have already discussed this. And in that, we used to calculate the Z score. Then we used to refer the normal distribution table. And for this Z score, we used to calculate the probability there. Okay, let me just show you. This was the normal distribution table, correct? You remember we studied that area from the left to the Z score is this. And these were the values that are there, correct? These are the values that are there, the different probabilities. So these are the probabilities value at a Z score of minus 3.9. So that is how it used to be, right? So it gives us a relationship between the Z score and the probability, the area under normal curve. In this case, we are given the probability, right? We have been given the probability. What is the probability? Level of confidence. Let's say it is 95%. Then what is the Z score going to be? So in this, we have to calculate the reverse. In this, we are given the probability and we have to take the Z score. Simple. Correct? And then the formula for VAR is Z score multiplied by standard deviation. This we have to put for the relevant time horizon. Okay, this is called as value at risk, in which we have to put the Z score and the standard deviation. So Z score will come from the level of confidence, whatever it is. It will be seen from the table and put in here. And the standard deviation will always come in absolute. Students, now please note, this is a very important point. This will be coming in this, okay, always absolute. Always put absolute, not in percentage. We will see through the questions how. Z score using table, take probability and find Z score. Simple. Relevant time horizon means given in question. It can be 1 day, or it can be 10 days, or it can be any number of days. For that only we have to take the standard deviation. This is called as VAR. Simple. Now, let us derive some other useful things. So students, if you see, variance for a particular time period would be equal to variance of 1 day, correct, multiplied by the t. So this is actually 1 day absolute amount. T is equal to the number of days. Now, for example, okay, we will just specify this and then we will go to the example. So let's say the time period is 10 days. We have to calculate the variance for 10 days. For that, we will take the variance for 1 day and multiply with 10 here. Correct. This is variance for 1 day. So 10, if you multiply it with 10 for variance for 1 day, we will get the 10 days variance. Now to get the standard deviation for time period, can we say square root of variance of 1 day multiplied by t, correct? I've just taken the square to square root in the seconds in the right hand side. So standard deviation for time period is equal to standard deviation of 1 day multiplied by under root t. Simple. This is a very important conclusion which all of us have to remember. So to calculate the standard deviation for 10 days, for example, we will have to take the standard deviation of 1 day and multiply it with the under root of t. Under root of t, which is 10 days. Under root of 10 days. Okay. And similarly, var for t days will be equal to z score multiplied by standard deviation for 1 day multiplied by under root t. I hope this is also understood. Correct, because we have studied that normal var is what? Standard deviation of relevant time period. So if we have broken down the standard deviation of relevant time period into this standard deviation of 1 day multiplied by under root of t, which we have put in here. Simple. Again, I am specifying this standard deviation will always come as absolute. And there is a last relationship also that we can put, where for t days is equal to where for 1 day multiplied by under root t. Simple. Because if you see this till here is actually var for 1 day, correct? Z score multiplied by standard deviation for 1 day is the value at risk for 1 day. So we can, if we are given value at risk for 1 day, we can just simply multiply with the under root t to arrive at var for t days. Simple. Let me again bring the conceptual clarity. So value at risk, students, we studied that it is one kind of a mathematical model Okay, quantitative finance, which will give you some kind of a maximum potential loss at a certain level of confidence by using standard deviation of returns, value of portfolio, and time horizon. Simple. What is the time period? We studied that what do we mean by level of confidence? Level of confidence is just simply the probability of maximum loss happening. So we studied that probability of maximum loss that can happen up to 20,000 is 95% within one day, which is the example we have studied. And the reverse of this will be the probability is 5% that the minimum loss is 20,000 in one day. Correct? That is called as the level of significance. We also studied that since the returns from the securities are normally distributed, we make use of Z score. So Z score will be derived from the normal distribution table. In this, in the Black-Scholes model, using Z score, we used to find the probability. But in this, we already have been given the probability. Using probability, we will find the Z score. And that Z score will be used in the calculation of VAR. This standard deviation, we said that always it will come in an absolute amount, not in percentage. What is the absolute amount of standard deviation for the relevant time horizon? And we also studied that to convert the standard deviation of the relevant time period, we can take 1 day standard deviation and multiply it with the underscore under root t. And for where for t days will be the z score sd 1 day and underscore t. And similarly for var t days will be var for 1 day and under root t. Okay. These are the formulas that we have studied. Okay, students. So let us break for 10 minutes and then we will solve the questions. And then after that, we will hear it from CA Ashish sir on the overall examination point of view. Okay. So we will come back at 8:41. So welcome back, students. Let's attempt these questions. First of all, let me go to the distribution table. Where it is, where it is, where it is. The normal table. Yeah. Okay. So let us go to the questions now. Before that, okay, there are some queries. Let me take the queries first. Namita is asking, please explain 4 bulleted points on first point on page 14.10. I hope you're asking from startup finance. Yeah, I hope Namita you're asking this deal origination, right? Which is the sector focus, stage of business focus, promoter focus, and turnover focus. I hope these are the points that you're asking. So if you see, Namita, this is basically the VC investment process. Correct? 14.10 page number for all the other students if they want to refer on the study material. So they say that what is the VC investment process? The first part in the VC investment process is definitely the deal origination. Correct? As we have studied that there is a management or advisor to the fund. Where is he? In this we studied, right? There is a manager or advisor to the fund. Correct? So he will be acting as an intermediary and he will basically get the deal. He will identify the deal. He will get the deal originated. And before the deal it is sourced, so he basically he would so basically the VC, the venture capitalist, correct, would inform this manager slash advisor not to search any kind of deal, but to stick to certain requirements, correct, so that at last the efforts is not wasted, correct, and the time is not gone. So he will say that I have a sector focus. I want the startup to be there in the particular sector. Sector means there are different sectors, right? Automobile sector, FMCG sector, or let's say in a services sector, food services sector, any kind of sectoral focus that that venture capitalist might have. He will tell this to the manager or to the advisor that you always look for the startup in this particular sector. Okay, don't go in any sector because that will just waste our time. Number one. Number two, stages of business focus. So at what stage the business is. For example, if it is a very in the smaller stage, it is just started. So some venture capitalists would be interested in that, or some venture capitalists would be interested in the medium level business, right, which has started, let's say 2-3 years back, and now it is already at certain kind of operating level. From there they want to take it to the next level. So that is a stage of business focus. Third is the promoter focus. Promoter focus means who are the founders, correct. I mean, what background do they have? Are they professionals, or are they coming from the business families, or what kind of focus the promoter wants to have, or even what kind of profile that promoter have. Then the turnover focus. So the turnover focus means what kind of growth that they look into, correct, what is the right volume growth and the price growth that they're looking into, correct. So those all things will come into the turnover focus. So basically these four things, specifically the general partners itself or the venture capitalist itself will specify it to the manager slash advisor that you go ahead and find the deals around these four focuses only. Okay, Namita, I hope I'm clear. Sairam is asking, sir, in exam, Z score value is given or not? Definitely, Sairam. Either it will be given in the question or you will be given a direction how to calculate the Z score in examination. We will solve the questions. We will see how we can find it. Now, I think the where is clear. Now let's go to the question number 1. Yes, all set. The where on a portfolio using 1 day time horizon. Okay, one more thing I forgot to tell all of you is, see what are the use of where, value at risk. Sorry. Students, if you see a lot of companies today are doing the risk management, correct? Let's say there is a company who is into the business of creating the portfolios. They are the asset management companies. They need to know that how it is going to phase it out. I'm just taking one more minute before we jump to the question. See, the conceptual understanding is done till now. I'm just giving you something practical, why and where it is used. Okay. So now if you see VAR, it is generally, let's say, if you talk about a company who has created a portfolio. Okay. I'm giving you a practical example. Now, while creating this portfolio, they need to know that over next 20 days, okay, the time period is, let's say, 20 days. The level of confidence is 95%, correct? And the portfolio value is 10 lakhs. Hence, the maximum loss using VAR and the standard deviation is also given something correct. Using that, we have calculated the maximum loss using VAR. It comes out to, let's say, 5,000 rupees. Now, this information is given from VAR that 5,000 rupees is the maximum loss that you can incur in the next 20 days. And the probability of that is 95%, correct? For having the maximum loss of 5,000. Now, how does this company uses this information? Now, what does this company will do is, okay, I have this. Now, can I also say that out of 20 days, in one day, can I expect one day expected loss to be 5,000 maximum? How I have calculated one day? I have taken 20 days and multiplied 95. So basically 100% minus, sorry, this is minimum. So 100% minus 95%. So I have multiplied it with the level of significance. This statement I have just changed. So out of 20 days, in one day, expected loss to be 5,000 or more. This is the right term to put. So that means the minimum loss is 5,000 because we are using level of significance. So in this 20 days, one day, our loss will be more than 5,000. Balance 19 days, our loss will be maximum 5,000. Loss is maximum 5,000. One day, loss is minimum 5,000. Can you see now the information of this 5,000 from level of significance and level of confidence has changed to what is the number of day looking like? It is going to be like this. So, and now the information can be used by them to plan their investments better, to plan for their portfolio better. Okay, students. So this is another way of looking at it. Now coming here, Namita is asking, sir, where is equal to Z score into SD? Please explain what does this formula says. So that's what, Namita, I have just now told you, that this will give us the maximum loss. In our example, what we have seen is, see, this was our example, right? So this is the resultant of that formula. Maximum loss will be coming as 20,000. And that where is basically meaning this: within one day, the maximum loss is 20,000 with a given level of confidence at 95%. Or the chance of maximum loss happening at 20,000 in one day is only 95%. That is called as VAR, simple. Okay. So the Z score multiplied by SD is giving you this 20,000 rupees value. That is VAR. Okay. And the meaning already we discussed. Now let's see the questions so that all of your understanding will be stronger. So VAR on a portfolio using a 1 day time horizon is 100 crore. What is the VAR using a 10-day horizon? Simple. So they are saying VAR for 1 day is equal to 100 crores. And VAR for 10 days will be how much? Now you see students, 100 crore is a very big amount. That means the value, the maximum loss that that portfolio is exposed to is 100 crore. You can imagine the value of that portfolio, how big it will be. Correct. But anyway, that is not the part of our question. So we know that, first of all, var for 10 days is equal to var for 1 day under root 10. Correct? This is coming from this formula. This formula it is coming. Var for t days is equal to var for 1 day multiplied by under root t. So this comes as 100, which is the var for 1 day under root 10, which is equal to 316.22 crores. So var for 10 days is equal to 316.22 crores. Simple. So what does this mean? Now, for a 10-day period horizon, the maximum loss that can happen to the portfolio is 316 crore. In 1 day, the maximum loss that can happen is 100 crore. Simple. In this, the level of confidence and significance is not given, hence I'm not using that anywhere, and that's not even required as well. Okay, students. Coming to the second question. Okay, all of you please note it down. Then I will go to the next question. Very simple, very easy, just a one-liner question. Yeah, now let's go to question number second. If the daily VAR is 1,25,000, students, please note these questions are already uploaded in the assignment section. Please go from there and check it if you are not having a copy of it. If the daily VAR is 1,25,000, calculate the weekly, monthly, semi-annually, annual VAR, assume 250 days and 50 weeks per year. Simple. So they are saying that VAR for 1 day is given, you have to calculate weekly, monthly, semi-annually. So first of all, we will calculate the weekly VAR, correct? Now there are 250 days and 50 weeks in a year. So that means 5 days per week we can use, correct? Because we are saying in a year, there are 250 days and 50 weeks. That means how many days per year? How many days per week? It's 5 days, okay? So it comes as 1,25,000 multiplied by under root 5 for 5 days. So this is coming as 279,509. Then comes monthly. Monthly will be 1,25,000 multiplied by under root of 250 divided by 12. There are 12 months in a year. 250 is the total number of days, and we will take divide by 12. We are just taking the assumption that is given in the question. Correct. We are not taking 30 days. We are not taking 31 days. We are just simply taking 250 divided by 12. So this comes as how much? 11,88,634. This is the monthly VAR. Now the semi-annual VAR. $1,25,000 multiplied by 250 divided by 2. Correct? 250 for full year. Semi-annually will be divided by 2. So this will give us 1397, 542.50. Students, please note, don't think that we can just multiply the monthly VAR by 6 and arrive at the semi-annual VAR. No, that's not the right approach. Why? Because it's not directly proportional to time. It's a under root of time, correct? We have studied the derivation as well. So using that only we are saying, because the variance has to be multiplied with the number of days to arrive at the standard deviation, not the standard deviation itself. Okay. Then the annual VAR. will be 1,25,000 under root 250. This is equal to 1976,423.5. Simple. So Namita is saying, sir, an example, why our maximum loss is 20,000 in stock market, we can lose entire 20 lakhs. Okay, Namita, I'll tell you. I got your query. Just give me 1 minute. Let this question happen. I will explain in detail. Second query from Namita is, please solve question 1 in which we need to calculate VAR. Namita, I've already solved that question number 1 because that was relatively very simple. Question number 3 and 4, we will calculate the VAR. You will see that the VAR calculation, valuator's calculation later. All of you please note it down. Then let me take the first query. Okay, shall we move? See, now Namita is asking a very good question actually, which will be there in all of your mind. See, let me just take this example again, correct? This is the starting point. Now, we said that confidence level is 95%, okay? Portfolio value is 20 lakhs and there is some SD. I mean, I'm not taking SD here. There will be some SD that is already given. Using that, we arrived that there is a maximum loss of 20,000. Now, Namita is saying that in stock market, there can be a situation where we can lose entire 20 lakhs. I am also saying yes. Namita, I am also saying yes. How? See, I am using this statement to tell you the same thing, which you are also saying. What I'm saying is that there is a 5% chance that your loss will be minimum 20,000 and it can be up to the upward, it can be even 20 lakhs. We're getting my point. We are just playing with the words here, Namita. We are saying that there is a 5% chance that your minimum loss is 20,000 and maximum it can be anything. I mean, on the upper side, it can be anything. If I have to explain this, see, where, which is 20,000, this is the maximum loss. Once we talk about the confidence level, correct? So this 20,000 will become minimum loss. If we talk about significance level, correct? Because if there is a 95% chance that maximum loss is 20,000, then there is a 5% chance that the loss will be minimum to 20,000. If the loss is minimum to 20,000, so let's say this is 0, this is 20,000, and this is the 20 lakhs. This is the value of portfolio. This is the value of, this is the VAR basically, and this is the 0. So now what I'm trying to say is, there is a 95% chance that your loss will be from 0 to 20,000. But there is a 5% chance that your loss will be from 20,000 to 20 lakhs. Okay, Namita. So we are also saying the same thing. Even the VAR is also saying the same thing, but in a professional manner, assigning probabilities to it. Okay. So yes, stock market, you can lose entire 20 lakhs. There is a 5% probability that your loss will be higher than 20,000. We don't know whether it will be 40,000, 1 lakh, 2 lakh, 3 lakh, or entire 20 lakh. But there is a chance of 5% that it will be more than 20,000. Okay, students. No, Namita, it's not, in reality, it's not 50-50. So Namita is now saying that we have taken only 5% chance that it will be more than 20,000. But in reality, she is saying that it will be 50-50. No, see, that's not the case. Now the reality has to be seen from the past, correct? See, From the past, you know that what is the standard deviation, correct? From the past returns, you calculate standard deviation, and that standard deviation you project for the future. You multiply it with the value of portfolio and you multiply it with the probability Z score. And hence you try to project for the future using the past standard deviation. If the past standard deviation says that it is 100%, then I can understand there is a 50-50 chance. Standard deviation 100% means there is a 100% downfall or a 100% up that is possible in the value of portfolio. But if the standard deviation is only 2% or 3%, I cannot say that there is a 50-50% chance that the entire value will go down. You're getting my point? Again, go back to the portfolio discussion that I had, in which I told that standard deviation will tell you that what is the possible deviation from the possible deviation of the actual return from the expected return. If it is 100%, that means your entire value can be doubled or your entire value can be 0. Correct? But if it is only 2 or 3%, that means the impact will be rotating only within the brackets of -2 and +2. Okay, you remember that we calculated a range in SD, right? So hence, it's not a 50-50 ratio. We know that history has been that standard deviation is only 2 or 3%, and hence the future projection is. Now coming to the third question. Neil holds ₹1 crore shares of XY Limited. Whose market price standard deviation is 2% per day. They have already given for 1 day. So there is nothing to worry. 2% per day on 1 crore turns out to be 2 lakhs, correct? Simple. So I'm saying that always standard deviation use in absolute amount, not in percentage for VAR. So hence I've right away converted the percentage into absolute by multiplying it with the portfolio value. Assuming 252 days trading in a year, determine the maximum loss level over a period of 1 trading day. So time horizon is 1 day. Maximum loss they are asking, that means level of confidence is required. Because level of confidence will give you the maximum loss. Level of significance will give you the minimum loss, correct? For 1 day and 10 days. So T is equal to 1 and 10 days. We are given 2 scenarios. T is equal to 1 and 10 with 99% confidence level. If there is a 99% confidence level, what is T is equal to 1 day and T is equal to 10 days VAR? Assuming share prices are normally for the level of 95%, 99%, the equivalent Z score is 2.33. So they have given you the Z score as well. They have given you the probability 99%, which is the level of confidence. Since we are talking about the maximum loss, hence we have to see the level of confidence. Probability 99%, Z score 2.33. Even if they have not given this. Students, if you see, I hope the screen is visible. I'm just making it a bit larger so that we focus on that figure. Okay, this is the standard normal loss table. Sorry, not normal loss, standard normal distribution table. Okay. Now, if you see what probability we have, 99%, can we write it as 0.99? Yes. 0.99, correct. So that 0.99, let us search where it is. See, exactly it is turning here. That 0.99 is turning between this value and this value. So let us see what is this value actually. 2.3, correct? And on top, it is 0.03. So 2.3 plus 0.03 will give us somewhere around 0.99. Hence, 2.3 plus 0.03, which is actually 2.33. The same thing is given you in the question as well. The Z score of 99% probability is 2.33. Okay, students. I hope this is clear, right? Now we have to just apply this. Finally, what is the question asking us? See, what is the model? Model is we are talking about var. T is equal to 1 and 10 days. Two scenarios the question is asking us. One is for 1 day and one is for 10 days. Level of confidence 99%. This is the second input. SD 2%, or I can write 2 lakhs, correct? Z score using this level of confidence 2.33. Can we calculate the maximum loss? Yes. Let's use the formula and calculate. So SD for 1 day is equal to 1 crore multiplied by 2%. Simple. It comes as 2 lakhs, correct? That is what we have already calculated. SD for 10 days will be 2 lakhs under root 10. Correct? SD for 10 days will be SD for 1 day multiplied by under root of T, which is this. So it comes as 6.32 lakhs. Now, using this maximum, we will use the same sentence that the question has used. Maximum loss for 1 day at 99% confidence level. 2.33 is the Z score value, correct? Multiplied by the SD for 1 day is equal to 4.66 lakhs. Maximum loss for 10 days at 99% confidence level. 2.33 into 6.32 lakhs, which is equal to 14.72 lakhs. Simple. Simple. Okay. So the solution is very simple. We have just calculated the maximum loss for 1 day and maximum loss for 10 days. And for calculating the maximum loss for 10 days, we have used the standard deviation for 10 days, not for 1 day. Z score remains same, which is again at a level of confidence. Okay, students. After this, we will do our last question of the session and of the topic as well. Yes, Namita. So Namita is asking, sir, in 10 lakh portfolio example, yes, why we say that 5,000 minimum loss for 1 day as var is for 20 days. Okay, great. So actually now, Namita, if you see, I have represented in a separate manner. Okay, let me go to that particular example only. Yeah, this one, right? Yeah, this one. So we said that portfolio value is 10 lakhs. Okay, let it come. Yeah. We said that portfolio value is 10 lakhs. Maximum loss is 5,000 for a time horizon of 20 days. Correct. So there are two ways to interpret it. I'm not talking about from the level of significance and confidence. I'm talking about level of confidence itself. There are two ways. One is that within the next 20 days, the maximum loss that can happen to us is 5,000, and the chance of that, the probability of that is 95%. Simple. That is the normal way that all of us will agree, correct? But I'm just modifying the sentence to say that out of 20 days, 19 days is where the loss is maximum 5,000. Because what I have done, I have multiplied 20 by 95%, which is 19. To arrive at that, how many days there is a maximum loss of 5,000, and how many days out of that day will be the minimum loss. You're getting my point? So still the where is for 20 days. I'm not debating that. Where is still for 20 days. Okay, Namita. If you say the way I have told in statement 1 or statement 2, both the statements, where is for 20 days. But it's just a different way of seeing the where. Because in the first way, you are saying that 95% chance that loss is maximum 5,000 in 20 days. I am saying 19 days maximum loss will be 5,000. Simple. That's all. That is the only change. Correct. This is statement 1 and statement 2. Similarly, for the level of significance also, you can see 5% chance that loss is minimum 5,000 in 20 days. That means one day minimum loss is 5,000. Simple. Okay, now let me go to the last question. So the last question says that consider a portfolio consisting of rupees 20 crore. No, it's 2 crore, right? Yeah, it's 2 crore investment in XYZ and a 2 crore investment in ABC. The daily standard deviation of both the shares is 1% and the coefficient of correlation between them is 0.3. What is this coefficient of correlation? This we have already studied in portfolio management. You're required to determine the 10-day 99% value at risk for the portfolio. Simple. First of all, we need to understand that what is the standard deviation of portfolio. This we need to calculate. This will be calculated on 10 days horizon. Simple. Correct. So the standard deviation of portfolio from the portfolio management subject, from the portfolio management topic, we know that the variance is equal to weight of A, weight of B square, variance of B square plus 2 weight of A, weight of B, standard deviation A, standard deviation B, correlation coefficient of A and B. This we have already studied, discussed, explained in the portfolio management, correct? So I've just copied the formula here. Now we know that what are the weights, 0.5 and 0.5, right? Because the investment is equal in XYZ and ABC. So 50-50% is the weight. Can we calculate the portfolio variance? Yes. 0.5, 0.01. I'm taking 0.01 because 1% is the standard deviation, correct? For the respective share. Plus 0.5 square, 0.01 square, plus 2 into 0.5 into 0.5 multiplied by 0.01, 0.01, and the correlation coefficient is given as 0.3. Students, this is the same, exactly the same thing that I've done that we used to do in our portfolio management. If we solve this, the portfolio standard deviation comes out to be 0.8062%. Now, please note that this is all for one day, because in the question, this 1% is given for one day, the daily standard deviation, correct? The daily standard deviation for one day. Simple. So this we have calculated. So SD for one day. What is the total portfolio size? We have to calculate in absolute, right? As I told you that in VAR formula, we always put the SD in absolute. So this will be 400 lakhs multiplied by 0.8062%, which comes as 3.22 lakhs. Similarly, SD for 10 days, 3.22 multiplied by under root of 10. Simple, correct? Which is under root T that we have already studied in the formula. Rupees 10.18 lakhs is the standard deviation for 10 days. Okay. Now, what is the level of confidence is 99%, correct? As per our standard normal table. So again, the 99% comes as 2.33, right? 2.3 for this and 0.3 we will have to add for the above, correct? So it comes as 2.33. So we will use the same number here. So hence the var for 10 days is equal to 10.18 lakhs multiplied by 2.33, which is equal to rupees 23.72 lakhs. Simple. This is the var for 10 days. So students, with this, we have completed the startup finance as well as the VAR topic from my end. And now I request CA Ashish sir to please conclude the entire series of session. Yeah.
Thanks a lot. Am I audible?
Yes, sir. You're audible. Yes, sir.
Just only 1 second.
Yeah, sure, sir.
Welcome, friends. Now, since all things, good things comes to an end, and that's in this series, our association with you through the live virtual classes is going to end today. But it will not be the end of association at all, because we at Bodo Studies will be continue to be connected with you. So because it does not mean that after this class you cannot send your email, etc. You are free to send your email, and even you can contact me telephonically. Student, as I promised in my earlier classes also, that I would like to share some of my experience how to crack exam. So today my discussion will be on the same. Student, Divas, can you do something? You just
yes,
stop your this iPad if possible. I think
sure,
you
sure,
need to know. Okay. Then I share my slide.
I have stopped, sir.
No, thank you. I'm just sharing my screen. Is it visible?
Yes, sir. It is visible.
Okay, now. No, okay. Just 1 second. Now, student, once we have concluded our syllabus, and then we have to see how we have to crack the exam. And my experience is that although students have done a lot of efforts, put their best efforts, but still sometimes they fail in their examination because of some problems, because they have a complete knowledge as well as well practiced the question, but still they could not go through the exam. So after this today's discussion, I think you will not face this problem. Now, student, when I talk about this strategy, I will divide my strategy into 3 parts. That is 1 month before examination, 1 day before examination, and during the examination. Now, when I talk about the 1 month before examination, now see what we need to cover up. Although this strategy is basically for the SFM, but you can apply with some modification for your other papers also. First of all, it is very important to start winding up your syllabus, because it has been observed that sometimes students do the revision, practice the question, etc. But it is very important that you should start winding up the syllabus, because unless and then if you keep your syllabus open-ended till the end, then you will lose the confidence. So it is very important that you start winding up the syllabus at least by allocating 3 to 4 days for the each paper if you are taking up both groups, and if 7 to 8 days for the each paper if you are taking the single group. Now it is very important. You just make small notes in the bullet point form for revision 1 day before examination. See, student, what happens? Theory is an important part of SFM. Now it is an integral part because, as I maybe in 1 or 2 class I have mentioned you that now as per the structure of your examination, normally one theoretical question is attached to every numerical. So you cannot avoid the theory at all. So it will be better you refer the study material, underline the points, make your bullet points, so that of course you can write at your own in a detailed version. But it is very important that you should keep the key points in your mind. Next, very important, refer examiner's comment on the performance of candidate from the previous suggested answer. Student, you may have learned that we should learn the mistakes from the other. So this is the basis of the examiner's performance, examiner's comments. Now, student, examiner's comments are based on the performance, and they exactly let you know where the candidates or the student have committed mistake in their answers. So it is very important for you to refer these comments, because if you go through these comments after doing some question, then you will not avoid this mistake again in your examination. So this will be very, you can say it is a kind of a benchmark for you to avoid your mistake and score good marks. Next, very important, try to attempt at least one mock test in examination like conditions to locate your mistakes, shortcomings which can be avoided in the main examination. Student, it is very important. Why? Because see, one day and in this matter I will like to say that you should be honest to yourself. Whenever any mock tests are hosted on the website, please do not see it. My request to you. Okay, it is be honest to yourself, and at least one month before examination, but just go through your complete syllabus and try to attempt mock test in examination like condition. That is, you please assume that you are in examination hall, take the water bottle or water jug with you, whatever, and you lock yourself in a one room, okay, and no disturbance at all, and avoid the mobile, etc., and just sit quietly and calmly and attempt the exam in 3 hours conditions, because then you will able to know your space of attempting the questions. It might be possible that if I give you 10 questions, you may take your own time and solve the question. But if I give you the time limit, certainly then your speed will also be improved. So the mock test forms the basis of speed with accuracy. It is very important. So it is very important to take this exam. Be honest to yourself in this matter, and don't see it is a question is because it is also of course it creates a curiosity. And even my advice to you, please don't discuss with your peer about this mock test. Okay, so you just imagine that it is mock test is like your main exam. Now refer the RTP of the current attempt as well as previous 2 or 3 attempts if time permits. Because what happens, normally students, it has been observed that sometimes paper setter has adopted the question from previous RTPs as well. Current RTPs will give you the confidence, of course, that you have completed your preparation. Of course, you may find that some questions are repeated, or even all questions may be repeated, but don't worry, it will give you an exposure that, of course, yes, I have done this question, I've done this question, and my syllabus is now near to completion. Very important.
Sir, sorry to interrupt. The slides are not moving actually.
1 minute.
Yeah. Yeah. Now it is. Yeah. Now 1 month before examination slide is visible. Slide number 5 is visible.
Let me. Now I am. Now it is okay.
Yes.
It is
yes,
1 month before exam. Start winding up your syllabus.
No, sir. It is coming as refer RTPs of current as well as previous.
No. 1 minute. Now you see it. Now it is starting with a start winding up.
No, sir. Not yet. It is same only. Yeah, sir. Just reshare. Yeah, now it came. Now it came, sir. Start winding
I
up
think
cables by
I have to
allocating.
reshare it. 1 minute. 1 second. 1 second. 1 second. I just reshare it. Then it will be
Yes, sir.
1 minute. 1 minute. Now it is visible.
Yes, sir. Now it's visible. 1 month before examination, start winding
And
up.
start winding up.
Yes, sir. Yes, sir.
Okay. Now I am moving
Yeah.
to another slide. Just make me sure.
Sure, sure, sure.
Now it is refer RTP is coming.
No, sir. Not yet.
No. No.
It will come.
Okay, no
It
problem.
will come. I think in one. It is coming after some lag, so maybe it will come in 30, 50 seconds.
It may take some few seconds.
Yes, yes, yes.
Now it is coming refer RTP.
Not yet, sir. Not yet.
No, not yet. 1 minute.
Okay.
Then I do stop sharing. Then I again share.
Yes, sir. Yes, sir.
Is it coming now?
Yes, sir. Now it is perfectly coming. Now
It's
it is
perfectly
perfect.
coming.
Yeah, correct.
Now refer RTP of current value.
Refer
Okay.
RTP. Yes, yes, sir.
Okay.
Yes, sir.
Okay. If there are any problem, just let me know. Okay.
Sure, sir. Sure, sir.
Okay. Now, now it is very important that you should refer. Very important. As I've completed the RTP portion, don't pay heed to the rumors, especially the toxic contents videos on the viral on the social media. Now, student, it is very important. It is very important because I have observed that, and I receive a call sometime on regular basis because some student says, sir, there is a rumor that there is drastic change in SFM paper. Yeah, that this is this blah blah blah. Now, student, please note that always refer ICAI website, Board of Studies, ICAI BOS Knowledge Portal for clearance of your doubt. Okay, still you have any doubt, please contact us without any hesitation. Instead of paying to the hits to this rumor and watching the toxic contents of the videos and because ultimately because they create a sensation like news because and you if you are watching YouTube etc they will say this but ultimately there is nothing in the end. So please don't waste your time on these such toxic videos. Where whatever you need clarification, please just contact to us. Okay, next very important, contact BS I say for any clarification or information on amendments. Sometimes you may the doubt may raise that there is an amendment. So please contact in case of doubt, please contact to your BOS, and especially in paper of laws, income tax, where the amendments are regular feature, you can contact us. More important, student, in paper of SFM, basically there are no amendments at all. Okay, and okay, of course, contemporary topics will be there, can be there, and this knowledge of contemporary topic will come from the reading the financial newspaper, like we have covered SPAC in our discussion in the last class, and even there are another possibility like quant funds. These terms are new terms, and I think you should be well versed with the same. If the paper setter is asking one or two questions from the some contemporary topic, it is a part of the syllabus, we can say that, but there's nothing kind of an amendment. And very important last bullet, don't skip any topic as all topics are important. Student, it is very important. What happens, I receive the call from the student, they say, sir, you just suggest me three topics or four topics so that I can pass the examination. Student, please note that all topics are important, very important. Don't skip any topic, because what happens, as per the structure of the question paper, there is no case study scenario like a question, although there is on a basis of some cases, but normally each question contains 2 numericals and 1 theoretical. So it may be possible that you may be good in the part 1, sub-part 1, part A question, the question number 3. But since you have skipped one topic, the part B is based on that topic. Now you will lose the unnecessary marks. So it will be a problem for you because there is a random mixing of the question. It does not mean that with the merger of acquisitions, the forex question will be asked. It is the mixing, random mixing. So please be ensured that don't skip any topic. Now, next very important, revise. Now we come to the 1 day before examination. Revise what you already have done. Student, it is very important. Well, please revise those things that you have already done. Okay, and if anything has been left, you can cover it in a very brief manner because you have one holiday leave 1 day holiday before your examination. But don't try to attempt any new question at your own, because getting wrong the answer will lead you to lose your confidence. Normally, in case of a numerical questions, what happens? Questions, whatever you have tried, please try the same. And even if you come across any new question, so my advice to you, please don't try to attempt at your own, because in case you get the wrong answer, you will unnecessarily may lose the confidence. So please avoid this. If you are confident that even if you get the wrong answer, you will not lose the confidence, then you can go ahead. Next, very important, the work that you have earlier done, that is, you have made bullet points in a small notebook. Now it will come for use. Refer bullet points and small notes for the theoretical papers prepared earlier. This is valid as well as for the theoretical portion of the SFM as well as for the theoretical papers. Now, you cannot, you have not that much of time with you that you can revise read everything and prepare your notes. So now this bullet point will work as a remedy for you. Next, for numerical papers, practice questions with small working notes and calculation. Now, sometimes students ask me, sir, how I should prepare 1 day before examination because time is very less. Now, student, in this matter, please note that now you cannot attempt each and every question in a full length manner. Of course, it is a time consuming. And if it may be possible that you may do some question and some questions may be left for revision. So in this regard, please note that you just do some scribbling. Okay, just carry out some small workings and make some calculation and get your answer. Okay, so because time is very less, you have to manage like that. Now, next very important, stay away from mobile phone and avoid discussions with your peers on any question, as difference on opinion can lead to confusion and panic. Now, student, it is very important. Sometimes what happens, just student, 1 day before examination, start discussing on any new questions. So student, please, or even sometimes difference, there may be some difference. So in that case, it may be possible that it may create a confusion for you. So my request to you, please continue to refer your questions. Please continue to, whatever you have read or whatever your concept, please be in the limit in the same. Don't try to argue with any your friend or peer, etc. on any question. Now, very important, keep your admit card, pen, and other stationery items, especially calculator. Very important. And my advice to you, please stop functioning at least for a numerical paper in advance so that nothing could be missed out in a last minute. And very important, student, next, take proper sleeps because it is well before examination. Don't try to sleep over, don't stay awake for the whole night because it will create a problem for you. My advice to you, please take your proper sleep and be fearless examination and go to the examination next day. And next, very important, take proper meal before going to examination. Now, students, sometimes it may be some, you can say, some kind of a stress or some kind of an excitement. Students normally skip their lunch, etc. before going to examination. Now, student, it will create a problem for you. Okay, you can have some gastric problem, then and your headache, etc. Then you can lose the concentration in examination. And because 3 hours of examination time is very important for you, so please try to avoid these things. Now we are coming to very important. What we have to do in the during the examination. First of all, it is very important that you should read the instructions of the questions as well as answer book very carefully. Although you are taking the examination on every day and you have in your mind set pattern, but my request to you, please at least go through the instructions of the question paper again, no problem, because it will take hardly 1 minute. Don't make judgment about the question paper in first 15 minutes of examination. Now, student, it is very important because what happens, since you are given the reading time 15 minutes before examination. Now, student, what happens? It is observed that a student make the judgment. Oh yeah, I cannot do this paper. Oh, what kind of this paper is this? How will I will pass? I will fail. I will. Then what will happen? That they start going into the unnecessary, mind-boggling things that this will happen. This will happen. So please, student, don't make any judgment about the question paper in 15 minutes. Just read the question paper in the 15 minutes and decide which question you have to attempt. Okay, these 15 minutes is basically for drafting your strategy. Okay, for the proceeding further. Next, avoid panic attack. It is very important. As a question paper is same for all. Now, sometimes if any out of the question league or out of the tough question paper has come, now students start get panic attack. Now, student, please note that you not to get panic. Stay calm, stay cool, because if you will not lose your patience and your calm is maintained, you can easily attempt the question, all questions. Okay, next, first attempt those questions which you know better. Student, please start with the questions that you know better, because what happens if you are getting correct answer in the initial of the initiation or in the beginning of the your question beginning of the question paper, you will start gaining the confidence. Okay, and it will boost up your performance. Next, don't spend too much time on a particular question, as stepwise marking will take care of incomplete answer. Now, student, it is very common problem. Like, since we are the student of an accountant of the accountancy, it is very common for us that matching of the balance sheet is our aim. Okay, but this matching of the balance sheet exam cannot be the sole aim or the sole objective in the examination, because so far as my studies concerned, my education concerned, I ensure that after my 12th class, my balance sheet has never tallied in any exam, even though I was getting a good marks. So because stepwise marking are there, and it will not take care of you. So similarly, suppose in the SFM, you have start attempting any question, and in the midway you are finding that you cannot proceed further. So please don't cross it. Okay, if it is a part of your choice question. Okay, so please don't cross it. Of course, if it is an extra question above or over and above, then you can cross this question. But if it is a part of your main portion of your answer choice questions, so please don't cross this question, because you can get at least 2 or 3 marks for your initial steps. So stepwise marking is the basis of your evaluation of examination pattern. So please, even though examination your answer is not complete, so don't worry, stepwise marking will take care of it. Now, very important, what happens if too many unseen questions come into the examination? Now, student, of course, in a paper like SFM, it has been observed that examiners normally adapt the question from study material, practice manual of the old scheme, RTPs. But sometimes what happens, the questions are new, totally new. You may say, oh yeah, I have never done this question. But student, please see, actually the question is the same, only the concept the concept is the same, but the question they have twisted. Okay, it is, give you very good example. I think it was somewhere in around May 18. I think in your examination, one question from the mutual fund has come. This question was basically the question based on the practice manual, and as per the practice manual, the question requires you are required to calculate the yield on three mutual funds. Now, in this question, in this attempt, what happens? They change the direction of the question. They ask, they have given the yield to you, or you have been asked to compute the number of days of investment. Okay, because in the earlier question, number of days of investment was given, but you are required to compute the yield on the three funds. Now here you have been provided with the annual yield, but now you need to calculate the number of days of the investment. So it is very important that you should be see that whether the question's language has been changed, or even language can be there can be some twist or googly kind of a thing in the language. So it is very important because inclusive or exclusive matters a lot. Suppose a question has come to your examination from your study material or practice manual. The word was there inclusive, but here the examiner has said exclusive. So please be sure. Okay, don't lose your patience. Just read it carefully. Now, how we move about this question when it is there? Stay cool and calm. Very important. Don't think of leaving the examination hall before 3 hours. It is very common practice that sometimes students leave the examination before 3 hours. They say, I cannot do the paper. My request to you, please stay there at least for the 3 hours and try to read the question more than one time, again and again. And try to link the facts provided with the concept we have studied. It is very important because this thing has happened to me when I was in the intermediate examination. It was very long back, somewhere around, you can say that it is somewhere around, I think it may be 30 years back somewhere, when I attempted my I have taken my this intermediate examination. I think November 93. It was November 93 attempt was there. So I remember what happened. There was one question in the costing. It was a very long question, and I have left this question. This was a compulsory question. I thought I want to attempt the question, and when 20 minutes have been left for the examination, I was planning to move from the examination hall. But since we two friends were coming together on a bike, so I thought my friend will not he will not move from the examination before 3 hours. So what I did, I start reading the question again and again. You won't believe, student, for the first 10 minutes, because 20 minutes have been left, I give the reading for the 10 minutes very patiently. Then in the 5 minutes, I noted that the question, there was nothing in the, because it was running in 2 pages, but the answer was lying in the last para only. And you won't believe, in the last 5 minutes, I have attempted the question and I have scored this marks in a good marks in this paper, due to which I could clear my group. Had I left this question and I had moved out of the examination hall, I may not be the what I would have been. I cannot tell. Okay, maybe I have not cleared that group in that attempt. So please don't leave the examination. Now, it is very important. Generally, previous examination question are reversed. That is, answer is given and base figure is given. As I told you that, like mutual fund question example I have given you, yield is given, days have been asked. And very important, assume x or y as the answer and then carry out reverse calculation. Sometimes you may need to find some figure, so you may not find suitable, or you may not come to your mind how I can compute this figure. So in this case, it is always better just you assume any x or y and apply some mathematical logic. Then you will get your answer. Okay, student. Now next, very important, during examination, write properly question number on the top of paper of answer book. It is very important. Whenever you attempt any question, please mark the question number on the top clearly and visibly. Okay, so because what happens, sometimes students forget to mention the question number, or they give the wrong number, so it can create a problem. So it is always better you just give the clearly on the top question number as well as part number. Why to link the questions on the other material you have referred for the study? Of course, as I've given you the example, there is a difference between the word inclusive and exclusive. Answers of the question should be supported by reasonable working notes. Now, it is very important, students. Now, sometimes it has been observed that students have carried out the working notes in a rough working and write down only the main answer. In that case, you will lose the unnecessary the marks. So carry out the reasonable working notes in your answers. Now you will ask, sir, how much is the reasonable? So student, for this, I will suggest you to refer the practice manual where you can understand what should be the length of the reasonable working notes. Now you cannot say you will write 2 + 2 = 4. That the examiner knows very well. But at least for some figure, how you have arrived some figure, that must be make it clear by your working notes. Next, if time permits, please revise your answer. It is very important because sometimes you may find any error or any inconsistency in your answer. You can at least make some last time correction. And very important, before handing over the answer book to the invigilator, please ensure that you have entered correct roll number and mark the questions attempted correctly. Because I think there is some the beginning there is some table where you need to tick mark the question that you attempted. So please make sure that this part also and properly just stitch or you can say enclose your extra answer books with the main sheet in a orderly manner. Say if you have started using you have used 3 extra answer books. So of course there will be numbering 1, 2, 3. So you just put them or attach them in an order. They should not be mismatched with the same. That is 3 is coming first, then 1, then 2. They should be in a proper order so that your answer could be continuously it could be verified continuously. Okay. Now, very important. Which material should be referred? I think just now, student, this is the addition. You can refer for your examination, but please note that because it is the October 2021 edition, and here it has been mentioned that relevant for the May 2020. But please note that if any student has referred our earlier edition, so don't worry because on this page, on a page number 10, we have mentioned the significant changes in the study in this edition. So you can do one thing, you can continue to refer your old study material, that is previous edition to it. The previous edition to it, you can refer the same and take a printout of these pages. I think these are somewhat 3 to 4 pages only. I think these are only 3 pages are there. You take a printout and make relevant correction in your previous edition study material. So it does not mean that we are promoting you to buy the study material. If you have done and don't lose the confidence, I have referred the old study material, the previous edition study material. There is no harm in the previous study material. You can continue the same, but with some small corrections. Okay, student. Now, in the last, what we need to refer? Suggested answers of the both scheme. Okay, as well as possible. Please refer because for the old scheme, you can skip the questions relating to the 4 topics. That is capital budgeting with risk, leasing decision, dividend decision, and financial services. So any question relating to the same, you just avoid the same but refer other topics are common topics. So please you can refer the suggested answers of the both scheme as well. It is very important. Even you can refer the May 18, but May 18 examination almost same was the same question have been included in our practice study material. So it is very important that you should refer the same. Now we are coming to the structure of the question paper. The question paper, this carries 100 marks. The time allowed is 3 hours. Total number of questions are 6. First question is compulsory of 20 marks, consisting of 4 subparts normally, so mostly numerical, or it can contain even 3 questions. Choice out of the remaining 5 questions, you have to complete 4 questions because each carry the 20 marks. And these are the mix of theoretical as well as numerical. So this is your structure of your examination. Now, student, in the end, I'm sharing again my email ID and as well as the contact number in case of any doubt. Now, student, it is very important that whenever you send any email, please do mention your name, registration number, or telephone number. Please, student, please note that we are here to help you. Please don't hesitate to share your details with us because we at the Board of Studies are here to help you and go through your examination. Now, student, since we are coming to the end of the session, and I would like to acknowledge, one second. I would like to acknowledge the name of some students who have kept this interaction these sessions all are around very interactive. Of course, there are an n number of students are attending the session, but some of the names that I have noticed during our query session. So I'm just starting giving their name. And student, please note if some name has been missed out. So please, I apologize for the same. I have no intention to leave any particular name, but still, if, I'm just reading the names: Naveen Prakash, Shubham Hida, Namita Goyapande, Sairam, Malisham. If I'm wrong, please, any wrong name please forgive me for the same. Sumit Jain, Rahul Rahuja, Harshad Gohil, Tejo Akash, C. Rohita, Jitendra Kumar, Daksh Agarwal, and there may be some other name also, but if any name has skipped, so we are acknowledging their name because they have kept the session interactive all around. And student, with this, I thank you all for taking participation in this class. Now, my request once more again will be to you: once you clear your exam, at least drop an email and share your feedback and suggestions through email. Of course, you are sharing your feedback. That is not we are have a visual on the same. But I want the after passing the examination, just I need some mail. If it will be appreciation mail, then it will of course it will encourage us to and boost our performance in the future because we are also taking an exam in this manner. I say I am also doing an exam. And of course, you please share your views also and suggestion also. That will be betterment for the future. Okay, students, all the best for your examinations, and may this year bring happiness and flying colors for you, and you become the members of the institute. And whenever you give me the call, so I want to listen, sir, I am the member, this. So we will like to listen. And thanks a lot, Devas, for your all the effort that you have put in. Now, student, for Devas, I would like to share one thing. Basically, Devas is a CF of a company, but out of his academic interest, he has. I have requested him, and he is ready to share his views. And but once it's my confession that when he teaches, even I become a student. I love to become a student of him because that and even in practical touch is also there. So Devas, thanks a lot. We will seek your service in future also.
Okay, thanks a lot, sir. Thank you, sir. Yeah, thank you, sir, for giving me this opportunity as well. Yeah, thank you, sir.
Okay. You have proved this class very good one. And in the last, I will also my tech support team, and other their members. Technical team